Underpriced stocks are basically money signs. From long-term to short-term investors, you need to be able to see when a stock is undervalued. If you want to be better at seeing these dollar signs, watch this video until the end. There are a lot of reasons as why a stock might be undervalued. We can't talk about all of them, but let's take a look at the 6 biggest reasons. First, market moves and herd mentality. We already talked about this in my last video. The market is emotional and reactive. When the market is hot and prices are rising, people are buying. They see what they could have made in the past few weeks if they would have put more money in the market, and they start chasing stocks for quick bucks. They develop a fear of missing out. In contrary, when the general market is down and stocks prices are falling, loss aversion push people to sell their stocks. People then accept their losses by selling instead of waiting for the market to get back up. This behavior is widespread and affects the prices of stocks, making the downward and upward market movement bigger and faster. Second, market crashes. When the market reaches unbelievable high, the chance of a bubble gets higher too. The level might get unsustainable and investors can end up panicking, leading to massive sell-offs. This increases the probability of a market crash. For example, this is what happened in the early 2000s with the dot-com bubble. The tech stocks shot up in value beyond what the companies were worth. Third, unnoticed and unglamorous stocks. You may find really great investment opportunities in undervalued stocks that may not be on people's radar, like small caps or even foreign stocks if you're doing more research than watching the news or looking at Reddit headlines. You can, for example, look for a good screener website or program that can help you discover new businesses. Most investors want in on the next big thing, such as technology startup, instead of a boring, established consumer durable manufacturer. For example, stocks like Microsoft, Apple, and Google are more likely to be affected by herd mentality investing than small companies. I'm going to make a video soon on how to use and where to find a good screener for stocks like I talked about. If you don't want to miss it, don't forget to subscribe. 4. Bad news. Every company will have bad news eventually. Some bad news are worse than others for sure, but that doesn't mean that the stocks won't bounce back or if the company is still fundamentally valuable. In other cases, they might have news bad enough that it can put a dent in the company's profitability. Analysts do not have a great track record for predicting the futures, and yet investors often panic and sell when the company announces earnings that are lower than analyst expectations. But value investors who can see beyond the downgrade and negative news can buy stocks at deeper discount because they are able to recognize a company's long-term value. 5th, cyclicality. Cyclicality is defined as the fluctuation that affects a business. Companies are not immune to ups and downs in the economic cycle, whether that seasonality and the time of the year or consumer attitude and moods. All of this can affect profit level and the price of a company's stocks, but it doesn't affect the company's values in the long term. 6. Diversification. Companies with cheap stock prices may have revolutionary goods and services, new markets, positioning, or even channels. Even if they may take advantage of circumstances that favor a new strategy or branch out in new area, brands that have historically been linked to a particular good or service are still valued fairly in the market. But the savvy investors will see this quickly. These are 6 ways stocks often become undervalued. Of course, there is thousands of reasons as of why a stocks might become undervalued, but it's often about these 6. As always, comment, like, and subscribe if you want to be a better investor in the future and make more money. Have a good day, everyone.